What happens when the world's largest asset manager begins looking beyond Bitcoin and Ethereum? Not because it has to, not because it's being pressured by regulators or pushed by retail sentiment, but because the internal logic of its own business model, the same logic that made it the dominant force in traditional finance, is pointing it in that direction. BlackRock manages over $10 trillion in assets. It didn't get there by chasing trends. It got there by identifying structural shifts in how capital flows and positioning itself at the center of those shifts before the rest of the market fully understood what was happening. When a firm like that starts evaluating which digital assets qualify for the same institutional wrapper that it applied to Bitcoin, the conversation stops being about crypto culture and starts being about financial architecture. And those are two very different conversations with two very different sets of implications. To understand what BlackRock's expansion into digital asset ETFs actually means, you have to start with what already happened with its Bitcoin ETF, because the Bitcoin story tells you almost everything you need to know about the institutional playbook. When BlackRock's Bitcoin ETF launched, there was genuine uncertainty about whether institutional and retail investors operating through traditional financial accounts would actually allocate to it in meaningful numbers. That uncertainty evaporated quickly. The product attracted consistent inflows even during periods when Bitcoin's price was dropping significantly from its all-time highs. That is not what you see with speculative retail products. When retail investors are in a product primarily because of price momentum, outflows accelerate when prices fall. What BlackRock's Bitcoin ETF showed instead was a pattern of accumulation during drawdowns. Financial advisors and institutional allocators were not exiting the position when prices fell. They were adding to it. That behavior reflects a fundamentally different investment thesis. It reflects investors who have made a long-term structural decision about the role of this asset class in a portfolio and who treat price volatility as an opportunity rather than a signal to exit. The distinction matters enormously because it tells you something about the quality and durability of the capital that is now flowing into this space through institutional channels. It is not hot money. It is not leverage chasing momentum. It is patient capital operating on 5 to 20-year time horizons, allocated by professionals whose job performance is measured over full market cycles, not quarterly price moves. When large institutional asset managers evaluate whether to create an ETF product around a digital asset, the criteria they apply have almost nothing to do with the factors that drive retail enthusiasm. They are not looking at social media sentiment. They are not looking at which communities are most vocal or which influencers have the largest audiences. The framework is entirely different and considerably more demanding. Liquidity is the first threshold. An asset needs to be tradable in sufficient volume that an institutional product can operate without its own trading activity materially moving the market. BlackRock's products manage capital at a scale where position sizes in individual assets can reach into the hundreds of millions or billions of dollars. If the underlying market can't absorb that activity without severe price impact, the product doesn't work. Regulatory clarity is the second critical factor. Asset managers of BlackRock's scale cannot afford to build and distribute products built on assets whose legal status is fundamentally contested. The question of whether a digital asset is a security or a commodity under U.S. law is not an abstract legal debate for institutional asset managers. It is the difference between a product they can offer and one they cannot. Market maturity and operating history matter for similar reasons. Institutions need to be able to model the behavior of an asset across multiple market cycles, multiple stress events, multiple regulatory environments. Assets with very short histories simply don't provide enough data to build the risk management frameworks that institutional products require. And finally, real-world use cases and institutional infrastructure matter because ETF products are ultimately sold to allocators who need to explain to their own clients and investment committees why a given asset deserves a place in a portfolio. Pure speculation is not a sufficient answer in institutional contexts. There needs to be a coherent story about what the asset does, why it exists, and why it has durable value independent of market sentiment. Against those criteria, XRP is one of a very small number of digital assets that appears in serious institutional conversations with any regularity. Its liquidity profile is among the strongest in the entire digital asset space. It has been operating continuously since 2012, which in the context of this asset class represents a genuinely long and stress-tested history. Its primary use case, facilitating cross-border payments and serving as a bridge liquidity layer between currencies, is a real financial function solving a real institutional problem rather than a speculative narrative. The regulatory situation around XRP has been complicated, and it would be dishonest to pretend otherwise. The SEC lawsuit against Ripple created years of legal uncertainty that meaningfully affected institutional comfort with the asset. But the resolution of that case and the evolving regulatory environment around digital assets more broadly has changed the calculus in ways that are relevant to how institutions think about it. Goldman Sachs disclosed holding nearly $154 million in spot XRP ETF shares by the end of 2025, making it the largest disclosed institutional holder of that product, according to Bloomberg Intelligence. That is not a speculative retail bet. That is a major investment bank making a disclosed audited allocation to an XRP product through the institutional infrastructure that exists. The critical point to be clear about here is that BlackRock has not confirmed any XRP ETF product. What exists is BlackRock's public signals that it is evaluating assets beyond Bitcoin and Ethereum using the maturity, liquidity, scale, and use case criteria described above, and the observable fact that XRP meets several of those criteria in ways that most other digital assets do not. The speculation that follows from those two facts is understandable, but it remains speculation until it becomes an actual product filing. The tokenization discussion is where BlackRock's strategy becomes most interesting and most consequential for understanding where this is all heading. BlackRock's CFO has publicly discussed plans to tokenize their ETF products, describing a timeline of 3 to 12 months for putting their ETFs on-chain. If you understand what that actually means operationally, the implications are significant. Tokenizing a financial asset means representing ownership of that asset as a token on a blockchain, which enables it to move, settle, and interact with other financial systems with a speed and programmability that traditional financial infrastructure cannot match. A tokenized ETF can settle in seconds rather than the T+2 days that traditional markets require. It can be transferred directly between parties without requiring a clearinghouse intermediary. It can be used as collateral in automated lending protocols. It can be fractionally owned and traded in increments that are too small to be economically viable in traditional market structures. The decision by the world's largest asset manager to pursue tokenization of its own products is not a marginal development. It is a statement about where institutional finance is going and what infrastructure it expects to run on. The specific blockchain infrastructure that will ultimately host tokenized versions of traditional financial assets is still a genuinely open question. Multiple platforms are competing for that role, but the direction of travel is now clear, and it comes directly from the institutions that manage the largest pools of capital in the global financial system. Stanley Druckenmiller is worth discussing in this context because he represents something specific. He is not a crypto enthusiast. He has not built a career around digital assets. He is one of the most successful macro investors in the history of financial markets, someone whose views on the trajectory of major economic systems carry weight precisely because they are not shaped by the biases of people whose professional identity is tied to any particular asset class winning. His evolving view on crypto, stablecoins, and blockchain infrastructure is therefore informative in a way that commentary from within the crypto ecosystem is not. Druckenmiller's current position is that blockchain infrastructure and stablecoins are genuinely useful tools for financial productivity, not useful in a speculative sense, useful in the operational sense that matters to the people running large financial institutions and managing the plumbing of the global economy. He has stated publicly that stablecoins could dominate payment systems within 10 to 15 years based on their structural efficiency advantages over existing systems. On the dollar's reserve currency status, his view is notable for its precision. He believes the dollar will remain the world's reserve currency for the foreseeable near-term future, but that it is on a trajectory that he doubts will hold over a 50-year horizon. That is not a prediction about a crypto asset price. That is a macro judgment about the long-term sustainability of the current global monetary architecture made by someone with the analytical track record to make it credibly. For the digital asset space, the relevance is that if stablecoins and blockchain-based settlement infrastructure do gradually absorb functions currently performed by dollar-denominated correspondent banking systems, the networks those stablecoins run on become structurally significant in ways that have nothing to do with speculative price appreciation. The infrastructure that Ripple has been building over the past several years deserves examination in this context because it illustrates what institutional-grade crypto infrastructure actually looks like when it is being constructed seriously. Ripple now holds 75 regulatory licenses and operates across more than 90 global markets. It offers custody services, wallet infrastructure, tokenization capabilities, stablecoin rails through RLUSD, and cross-border settlement systems through its on-demand liquidity product. The ODL product operates across 40 payout markets, delivers fee savings of around 90% compared to traditional correspondent banking routes, and runs 24 hours a day, 7 days a week without the settlement windows and cutoff times that define traditional banking operations. The CEO of Borderless, a company building on this kind of infrastructure, described the current moment as the emergence of stablecoins 2.0, where institutions are no longer looking for a simple payment token, but for modular infrastructure that gives them internal control over their entire financial stack, including compliance tools, wallet products, and settlement rails. That shift from single-function tools to comprehensive infrastructure is significant because it describes a transition from crypto as an experiment at the edges of the financial system to crypto as a core operational layer that serious institutions are building into their business models. That transition doesn't happen loudly. It doesn't generate viral content or dramatic price announcements. It happens in procurement decisions and partnership agreements and regulatory filings that most people never see or think about until the infrastructure is already embedded and the switching costs make it permanent. The actual story unfolding here is not about whether a single ETF gets approved or whether a particular asset reaches a particular price level. Those questions matter to traders and short-term market participants, and there is nothing wrong with paying attention to them if that is how you participate in this market. But they are not the questions that will determine how consequential this decade turns out to be for the evolution of financial infrastructure. The deeper question is whether the integration of digital assets into traditional financial markets through tokenization, ETF products, stablecoin payment systems, and programmable settlement infrastructure represents a durable structural shift or an elaborate cycle that will eventually reverse. The evidence from institutional behavior, from the capital allocations being made by the largest and most analytically sophisticated financial entities in the world, increasingly suggests that the structural shift interpretation is more accurate. The people making these decisions are not doing so because they are excited about crypto. They are doing so because their models of financial efficiency, settlement cost, capital utilization, and global market access are pointing them toward blockchain-based infrastructure as a necessary component of how competitive financial institutions will need to operate in the years ahead. That is a different and more durable foundation than retail enthusiasm or speculative narrative cycles. If the next phase of crypto adoption is driven by institutions and by the gradual tokenization of traditional financial markets, the digital assets that will actually become embedded in the system will not be chosen by which communities are loudest or which charts look most compelling on any given day. They will be chosen by which networks provide the infrastructure that institutions actually need to solve the problems they are actually trying to solve. And that selection process is already underway quietly in the boardrooms and risk committees and technology evaluations of the institutions that manage the capital that ultimately shapes what the financial system looks like.